Hey everyone, ZIM Integrated Shipping reported quarterly financial results, which I'm going to review in this video. I'm also going to update my buy recommendation for ZIM stock. Coming into the quarter, I had the stock on the borderline closer to a hold, but I had it on the borderline between a hold and a buy. So you're going to want to tune in to see if I'm changing that recommendation, upgrading it, or downgrading it following these investment results. So let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
The big story behind ZIM is that the company benefited tremendously during the earlier stages of the pandemic when people were spending more time at home and governments provided people with stimulus money and people spent that money buying things, right? And ZIM benefits from shipping things around the world. That created a surge in the volume of shipments around the world and created a surge in the prices of shipments. So ZIM benefited tremendously. But now it's experiencing the opposite side of that transaction where people are spending more money on services and less money on things, and that's hurting ZIM. It's decreasing shipment volume, it's decreasing prices, which we'll look at both a little bit later in the video. So that's kind of the brief history behind ZIM over the last 3 years. I think you need that to understand what's happening right now. So let's go right into it. So in 2021, the company took some long-term strategic actions, bringing in a renewal program where 46 of their new builds, 28 of them will be LNG powered. This is clean energy. This will help the company secure sales with other companies that are interested in cleaner energy, and it's supposed to decrease their costs of operations. The transition period will be between 2023 and 2024, where the company is looking to add cost-effective new build capacity, redeliver the expensive COVID-era charters, meaning the ships that it chartered and leased during the pandemic when prices were explosively higher. The company rented those ships too, right? So now it's going to bring those back. As those leases come due, it's going to return those, and that's going to help reduce costs for ZIM because it's going to return those highest priced ships that it has leased. That's going to help to be sure. Okay, looking at the company's key financial highlights in the quarter. So looking at the third quarter 2023, carried volume of 867 KTEUs increased by 3%, or I'm sorry, yeah, increased by 3% year over year. The 9 month level was down 2%. This is the first increase in several quarters, so it's a good sign. It could indicate that a bottom is in, at least in terms of volume for ZIM, and hopefully it continues moving upward from here. Unfortunately, freight rates, or the price it receives to ship that volume, is still down significantly, 66% down from the third quarter of 2022, and that was down even more from the third quarter of 2021. So the prices are down significantly after soaring to, it was close to $9,000 the freight rate dollar per TEU. Now it's down to 1100. It jumped and now it's coming all the way back down. And so that created a downfall in its revenue, down 61% in the quarter. It's down 62% in the 9 months ended in the most recent quarter. The good news is that the company is still free cash flow positive. In the third quarter, it generated 328 million in free cash flow, and in the 9 months, it generated 791 million in free cash flow. Again, that's down significantly from the prior year. Looking at the balance sheet, the company has $4.7 billion in debt as of September 30th, and it has $3.1 billion in cash. So the debt, not really a problem when you look at how much cash it has, 3.1 billion. The shortfall is 1.6 billion, and it looks like the company will generate roughly 1.2 billion dollars in cash flow in 2023. So it has about 1 year's worth of net debt. Should not be a big problem considering it's still generating positive free cash flow. considering it has the option to return some of those more expensive leases, and that should bring down its costs and improve its cash flow in 2024 and 2025, even if the rates and the volume stay low like they are right now. So the key thing to look at in this slide from ZIM is what I've highlighted here on the bottom. The year-to-date 2023, they've got 20 chartered vessels. In 2023, 5 additional vessels are up for renewal. Hopefully the company does not renew those contracts. And then in 2024, 34 vessels are up for renewal out of its total 145 vessels. So it can significantly reduce capacity in 2024 if prices remain low, or it can negotiate with these owners for lower prices for these vessels because it's a different market right now. It's a different market right now. And so the owners of these ships might come back to ZIM and say, don't return it to us. We'll let you keep it and we'll let you pay us half the price or 25% of what you were paying us before. So it's in a good position to negotiate that when that comes due in 2024. That's a catalyst to boost the company's profitability and cash flow in 2025. So in 2024, throughout the year, these vessels will be up for renewal, and as it renegotiates each one or returns each one, that will help reduce costs and improve profitability. So here's a closer look at the company's cash flow bridge in the third quarter of 2023. It generated $338 million in cash flow from operations, which is what you love to see as an investor. You want the company to generate cash from operations. You don't want the company to be generating cash from financing activities or from investing activities, because that is less sustainable than generating cash flow from operations. So this is good to see. The company only spent $10 million net in cash flow from in capital expenditure. That's good to see. You don't want to see the company investing in expansion right now in a tough macroeconomic environment. You want to see the company shrink its operations or negotiate better deals with the vessel owners if it is to maintain its capacity. So free cash flow came in at $328 million. The company paid back $451 million in debt and interest expense. I would like to see the company trim down its debt balance as it generates cash flow, because the interest expense is rising and interest rates have increased. So I'd like to see the company use some of its cash flow to start slowly bringing down that $4 billion debt balance, which will help reduce interest expense, which will again boost its cash flow from operations and its profitability on the bottom line. So the company has opportunities here to boost its profitability. The opportunities are not on the top line. They're not on revenue or increasing capacity or increasing sales. That's not where I see opportunities for ZIM. Where I see opportunities for ZIM are in the expense side of the equation, reducing debt, which will reduce interest expense, returning those vessels that are coming up for renewal, or negotiating extremely lower rates if the owners are willing to negotiate for lower rates. Otherwise, return those, shrink your capacity, and therefore operate at lower capacity, and you can charge maybe higher prices. Or if you're not going to be generating as high of profit per vessel, then operate fewer vessels, shrink the capacity in the market, and hopefully your competitors will also get the message, which is sometimes what happens if the market as a whole starts to take action to say, you know what, there's too much capacity in the market. Let's start to reduce some of this capacity. Let's park some of these ships. Let's not offer them for sale. Let's not offer their services for sale. And thereby that could increase the price per shipment for the industry. And so that's an interesting opportunity as well. That's where I see most of the opportunity for ZIM. Now, to answer the question if the stock is a hold or a buy, this is why last time I updated this, I was on the borderline. It's because the stock is so cheap. It's trading at a price to free cash flow of 0.284, extremely cheap, and cheaper than it's been in the last 3 years. However, The company's not in a good position. It's struggling. Shipments are down, prices are down, capacity is still increasing despite what I mentioned earlier, how it would benefit the industry to decrease capacity. They're not decreasing capacity, they're actually increasing capacity. And worldwide, there's been a shift to onshoring and less global trade, at least for the near term. So it's not in a good position economically, but it's still so cheap and it has opportunities to improve its profits just by improving its operations, right? Returning those ships, paying down some debt, and thereby increasing its profitability just by operating more effectively, being more nimble, being smaller, and thereby can provide a good investment return. So I'll keep this stock on the borderline, although I'll move it closer to a hold. I'll move it closer to a hold, away from the borderline of a hold and a buy. But the stock is so cheap that, if I was to take a chance, if I was an investor looking to take a chance on a stock, this could be a good one to take a chance on. Typically, I advise against taking a chance on those expensive speculative growth stocks that haven't shown, that haven't demonstrated they can be profitable, that haven't demonstrated they can sustain themselves. I would advise against those. And if you want to take a chance, here's a good one to take a chance on for those investors that are looking to take a chance on something. Otherwise, it's not in a great situation, but the stock is extremely cheap. For that reason, I have it, mixed on the borderline closer to a hold. All right, but before I let you go, if you gained any value from this video, please subscribe to the channel. It'll really help me make more videos just like this one. Thank you again for watching.